And good afternoon. It's a chilly day in Houston. My name is Randy Price. My associate and my partner, my good friend, is Matt Price, and welcome to the February monthly market update. In case you haven't tuned in, a lot going on in the world, and so we'll try to give you some perspective, some questions that we've been asked, and provide you with some insight. Again, our ultimate goal is clarity with regard to your investments, leading to confidence, leading to comfort. So with that, let's go ahead and kick that off. Who are we? We are the Price Group, family owned and operated. Myself, Matt Price, Maddie Kearns. We are serving folks that are close to or already retired. 80+% of our clients are retired. The key thing, if you're new and joining us for the first time, or even if you've been here for several, is we think it's very important for each of you to strongly consider working with a fiduciary, a real positive for your family as you take a look at who makes decisions and how you deal with conflicts of interest, etc. And we take that very seriously, and it's a very important factor of consideration.
So quite a few clients on the call. Looks like there are a handful of people who are not clients. So just by his way of background, Randy, myself, and Maddie, all certified financial planners. Randy and I went to the Wharton School of Business to get our CIMA, Certified Investment Management Analyst designation. We've been humbled to get a few awards from Forbes. Randy's gotten a number from Financial Times, Barron's, etc. The Retirement Insider is our weekly email. Most all clients will be on that. Anyone that's not on that, shoot me a note. Happy to add you as well. We do our best to continue to write and educate readers kind of what we see going on in the markets. A little bit more about our firm, Steward Partners, based off the biblical definition of stewardship. Our primary custodian where clients are held, Raymond James, they've been a great vendor, a great partner of ours, very fiscally conservative operation, and gotten good feedback from clients over the years with statements and things of that nature.
So one of the biggest questions we get asked, biggest discussions we're having as we meet with clients is, well, the world is changing. And so we thought it helpful to give you some dates here, key political dates to be looking at over the coming months as people are wondering how some of the new policies are going to affect their investments. One of the big questions, probably number one on the list, has been what about these tariffs or proposed tariffs against specifically Mexico and Canada? That's going to kick off on March 4th. You see, we've got the America First trade policy in April. TikTok debt limit should come up around August, and the Tax Cut and Jobs Act expires. And so expect a lot of conversation that is already started on how to reconcile a House and a Senate bill. Trump wants one big bill, one beautiful bill, as he says, and others like Lindsey Graham are wanting two different bills, and we shall see if that happens. But some key events to monitor. We are not extraordinarily concerned about the tariffs. I think a lot of that is posturing and negotiating, and so far it has not affected the market in a negative way. Speaking of trade, that's sort of been a focus when you think about that. The widening trade deficit, which we've talked about several times before, really supports Trump's tough stance on trade, and that is how easy is it for our American companies to sell goods to other countries versus how easy it is for other countries to sell their goods and services here in the good old mainland USA. And so, again, the level playing field has been thrown out there. And what happens if people are buying more of our machines, more of our computers, more of our technology, more of our energy, etc.? That leads to more jobs here. And so this could very easily be a real positive. But again, everybody's sort of concerned about a trade war and some of the histories where the trade war got started. Trump seems to think, and we would agree, that America has the upper hand here, and certainly he has the bully pulpit to talk about that at the present time.
Andy, let's go back a slide. Give us your thoughts on that December 31st date, the Tax Cuts and Job Acts with the former Trump tax piece of legislation setting to expire. What are our thoughts on that front?
So very important. If a bill isn't put into place, then the income tax rates, capital gains tax rates, and several other taxes, estate taxes, etc., would move demonstrably higher. We think a deal will get done, especially with a Republican Senate, a Republican House. It just remains to be seen. The devil's in the details, as the old saying goes. And we would expect things not to back up, not to get worse. Some of the things are being talked about if you happen to live or have relatives that live in a state that has state income tax, putting back in a deduction for the state and local income taxes. We never got that here in Texas, but during that time, we could always deduct sales tax. So anyway, remains to hurry up and wait, as the old saying goes. But we don't think it's going to be a huge impact unless something happens and you get closer, and we're not going to get the some sort of deal to make the bridge going forward.
One of the key pieces that is at least being talked about, who knows if it ends up happening or not, is Trump has talked at length about not taxing Social Security benefits. And so that would have a material impact on anyone's Live Well plan. Right now, for most all families, 85% of the Social Security benefits are taxable. For some families in a lower threshold, a lower income bracket, about half of it is taxable, but most of our clients are in that 85%. So doing away with some taxes on that front would be beneficial to most all of our clients receiving Social Security benefits. Let's take a look at the U.S. economy. We think currently it's on solid footing. 3 pieces of information here to look at, going from left to right. We think the consumer is still in a really healthy position. We've been saying that for a while, dating back to COVID in 2020. A lot of people were suggesting or talking about how the consumer might start to deteriorate or break down, stop buying goods and services. As many of you know, the consumer represents about 2/3 of the overall economy. So a big part of what we're looking at is are people continuing to spend money? And we think the answer, at least for the time being, is yes. We think the labor market there in the middle, we think it also continues to look healthy. Job growth maybe not as quick or as robust as we've seen maybe over the past year or so, but still creating new jobs. A little bit of a curveball there as it pertains to maybe government jobs moving forward. That could skew some of the numbers, just with the overall government looking to possibly reduce their headcount, possibly shrink at the federal level, that is. And then you've seen a real spike here over the last few months in business confidence. This is mostly small business owners who are more eager or compelled to go out and invest in to hire more people, and typically a lot of good things are downstream when small business owners are confident about the future. So absent some type of what we would call a black swan, something we can't predict, we think the economy right now does indeed look healthy. And on that front, we think there is a little bit of momentum with economic growth between now and Christmas, call it. We think the overall U.S. economy, the gross domestic product, or the GDP, grows anywhere from 2 to 3%. That actually would be slightly above the average there over the last 3 or 4 years. So we're not necessarily lighting the world on fire with that type of growth rate, but the economy is growing, which is not necessarily true in other parts of the globe. So we think that's a positive. If we can grow at this rate, and then if we can reduce the federal deficit, we think that will actually have a downward impact on inflation long term. we're big believers that inflation, a big part of that is driven by government spending at the federal level. And, you know, you can grow your way out of it, but at these growth rates, it's going to be really hard to grow your way out of it, which is really what happened post World War II. And so we think reducing that federal spending is the other arrow in the quiver, per se, of how to reduce inflation moving forward.
So again, a lot of questions on tariffs, and we thought we would cover, just for the educational purposes, some of the pluses and the minuses. So you see there the minus, the negative on top, and the positive in the green boxes on the bottom. And let's focus on the positive and where we think things would go. We think that the strength of the U.S. dollar will reduce the impact on prices as the U.S. economy continues to be strong, rule of law stronger, and some of the other countries not doing nearly as well. On the employment, we think that there's going to be more job creation. Trump has talked about if you make it here in America, there's going to be no tariffs. One of the major car manufacturers has already said this could influence his company from bringing some production back from south of the border in Mexico back to the United States. So these decisions and just the thought process of this could be an issue, I think could have a real positive there. More tariff could reduce the deficit, the federal deficit. And then on the economic growth, higher revenues and higher profits for domestic companies. But you know, there are a few negatives, but again, over time, it's amazing how many factories, how much manufacturing has left the United States for some of these same reasons, and getting it back would be such a huge positive for the country. Again, we don't see the tariffs as or the threat of tariffs as a real negative. S&P 500, the 500 largest stocks, fourth quarter for 2024. In the rearview mirror, 5 key questions as we come up into earnings season here. Companies have closed their books, and they're going to start to give us a peek under the hood on how they did. Valuations are obviously higher. Can earnings keep trending higher? That's what a stock is the present value of a future stream of earnings. So the higher the earnings go, typically the higher stock price goes, all things being the same. Can the earnings broaden beyond just the tech-related sectors? Everybody's interested in NVIDIA and Microsoft and Apple, etc. Number 3, how will companies manage the impact of tariffs? Again, assuming those do come due. How will the stronger dollar impact earnings? And last, will investment in use cases of AI continue to broaden? AI is something that we hear a lot of conversation about. How's that going to change your life? I've seen people, having letters written by AI. I talked to, for the first time about a month ago, an AI assistant, which was sort of a learning experience for me. But solid earnings season so far. 15% of the S&P 500 companies show growth. 75% of the companies beating their estimates, and 7.4% the magnitude of the earnings per share beat. Again, all above historical average. Hoping this continues. If so, it bodes well for the economic markets.
And one more thing on the earnings here, something that we've written quite a bit about last year, talked about so far this year with clients, has been how broad are the earnings across the overall market. And what we're seeing currently is the top 10 stocks represent almost 40% of the overall S&P 500. And so we would call that a very concentrated, narrow type of S&P 500 when you compare it to history. It's actually the most narrow or concentrated dating back to right around 2,000. So the past 25 years or so. And so what we think a healthy market looks like are when earnings are growing, not only in the top 10 stocks, but really they're broadening their earning exposure across the other 490 stocks out of the S&P 500. And that's what we expect. That's what we're seeing here. You're starting to see the non-top 10 stocks to actually increase their earnings, not in an equal rate of the top 10, but in a more kind of mainstream fashion. And so we think that's really healthy moving forward just for the overall stock portfolio. Our stocks, dividend growth, CWP enhanced dividend. Remember, we're really focusing on the, not really the top 10 stocks, but more really the other 490 stocks. We're looking for companies that not only pay dividends, but historically have increased those dividends year over year. And so we think that's really important for the type of investing we do for our retired clients.
So stay tuned as far as earnings are concerned. We'll cover that in some of our weekly market updates as well as our continuing monthly market update. But we appreciate your time, you being here. Feel free to reach out to anybody on the team with questions or comments. Email and phone numbers attached there. Again, our goal is to provide perspective to help you understand some of the complexities of walking through retirement. And if we could be of help, we're happy to do so. We sit down and talk with folks on a regular basis. There is no cost, there is no obligation. We tell people that if there's a common ground, we'll both know it. And if it's not, we think that you will leave as a better educated consumer, and we shall shake hands and part as friends and here for your help, your edification, your education going forward. So again, stay warm. Have a good rest of the day. And we are the Price Group. And as we say, everybody needs a wealth coach, and hope to see you real soon on one of our future webinars. Thank you.